Well, good morning and welcome to the Reserve Bank, and thank you very much for coming along. We're here to discuss the September issue of the Financial Stability Report. For those who don't know me, my name is Graham Wheeler, and I think everybody in the room probably knows Grant Spencer. New Zealand's financial system strengthened despite a challenging international environment. There has been a synchronous slowdown in global growth in recent months. The euro area remains in recession. There's been a marked slowdown in China, and there's been weaker investment in the US. Uncertainty around the global outlook remains high due to the scale of deleveraging, the slowdown in global trade, and the outlook for fiscal policy in the US, although there have been more recently some encouraging signs there in respect of the housing market and oil and gas developments. However, for the US, the euro area and Japan, real GDP per capita remains below the level that it was in 2007. Despite this, financial market sentiment has improved since our last report. Access to global funding markets has improved, interest rates remain low, global equity markets have recovered since June, and credit spreads have declined in the euro area. Our economy continues to grow at a modest rate. New Zealand banks have much better access to the global funding markets. New Zealand households and firms continue to reduce their reliance on debt, but household debt levels remain high overall. Borrowers are vulnerable to a potential fall in house prices. The other area I'd like to comment on very briefly is just leverage in the agricultural sector, particularly parts of the dairy sector, remains high, leaving the sector exposed to a potential fall in export prices. With that, let me hand over to Grant.
We're looking at the banks. We think they're in pretty good shape. They have continued to build their liquidity and capital buffers, thus improving their ability to cope with any stresses that might emerge either in funding markets or in credit quality. And certainly we think the banks are well placed to meet the increase in the core funding ratio, which we have increasing from 70 to 75% this coming January. On the policy front, we have quite a bit on the go. We have the implementation of Basel III. The core elements of that will come in January next year. We're continuing to develop our macro-prudential framework. We, as you know, working with the insurance companies for a new prudential regime for the insurance sector, and we expect to have full licensing of that sector by September of next year. Open bank resolution, this policy we're working on, you may have noticed we put out quite a wad of material last week on open bank resolution, and we're working towards having the banks pre-positioned for that by mid-next year. And finally, we are looking at a review of our own powers with regard to the oversight of the payments and settlement system. So we're looking to beef those up, and so we'll be doing a review of those powers over the next 6 months or so. And we'd be happy to talk further about any of those policy issues.
Okay. Well, thanks. We'd be very happy to try and answer all your questions as openly as we can. So the floor is open, please.
What's your level of concern about the dairy sector given the deterioration in loan-to-value ratios that the report highlights, and also the general fragility of the international economy?
I see yesterday's auction had higher prices, which is a good thing. But dairy sector debt has grown quite rapidly from 11 billion in 2003 to around 30 billion by 2009, where it seems to have stabilised. It represents roughly 10% of total bank and non-bank lending. I think the worrying thing from a prudential point of view, and it's something that the banks need to think about, is that half of the debt is held by the most, or the 10% most indebted farmers. And that's something that I think the banks, in managing their balance sheets, need to think about.
Thinking about it, if it's one thing for them to think about it, but by this, it looks as though they're continuing to lend enthusiastically to that sector. At what point does it become an issue for the regulator? And do you have all the tools you'd need to address that problem should it deteriorate, in your view?
Well, we look at it from the dairy sector's point of view, and obviously from the banking sector's point of view as well. So we're talk to the banks about the risk areas on their balance sheet, and that clearly is one of them. I think there's been some improvement in terms of risk management by the banks of the agricultural sector over the last few years, and I must say that the markets, the strong export prices, have given them room to do that. But we're concerned that if export prices were to deteriorate further, then they have to be very careful about preparing themselves for that. And if you think about the outlook for China right now, people are reasonably optimistic. But if China did come off and brought commodity prices with it, then there could be quite a significant part of the dairy sector that is under stress from a credit point of view.
In the report, you've mentioned that you're watching for signs of excessive credit growth, particularly in the housing market in Auckland, and that you've seen reports from the banks that have intensified their high loan-to-value ratio lending. What could or should the bank do if your concerns intensify?
Well, I think there's two aspects from which we look at it. One is what are the potential inflation pressures that are associated with rising house prices, and house prices picked up, I think, around 10% over the last year in Auckland, for example. But actual total credit lending, if you like, to the housing sector is still not growing especially rapidly. The other aspect that we look at it from is in essence around the prudential management side, and to what extent loan-to-value ratios are increasing. We have seen, particularly for first homeowners, loan-to-value ratios increasing in some of the banks. We're talking to the institutions about that, trying to understand their strategies better. We do have mechanisms if the housing market did at any point start to escalate too rapidly, then we do have mechanisms that we could come in and address that. But Grant, did you want to?
Yeah, I think that's a fair comment. I think the trend. I think there's not so much of a concern right now, but if the recent trend continues, then it could become an issue. I think the key in the housing market is to get the supply side going, because there is a supply shortage. It's not going to be solved by throwing more credit at it and pushing prices up further. And the more that happens, then the greater the risk is that eventually it could have a correction of house prices and damage in terms of credit exposure by the banks. So the household sector has continued to deleverage, and I think it's important for that trend to continue, and we're concerned if that was to start reversing.
What's your view on, for example, the Bank of Israel has introduced loan-to-value ratio limits, and the Canadian regulator has introduced loan-to-value ratio limits. What's your view on whether these should be the mechanisms used to address it if it does get worse?
I mean, I think the recent move by Israel was very interesting. I mean, they've got an economy that was essentially growing at around 3%. Like a lot of countries, they're experiencing upward appreciation in the exchange rate, but they also have a housing market that has been growing very rapidly, or price increases have been very rapid. I think of the order of 20% or something over the past year. And a lot of the investment in housing in Israel is by investors, if you like, owning second homes and the like. So I think the governor there, Stanley Fisher, faced a difficult choice, and that was in cutting interest rates in an effort to perhaps stimulate growth in Israel and to also perhaps try and get the exchange rate down. He didn't want to see rapid growth in housing prices. Canada has also had very rapid growth in housing prices. They haven't moderated since the global financial crisis, unlike the US. When those measures have been applied, they've tended to provide some degree of relief for first home owners. So they tend to look more at people who are trading up in the housing market, or otherwise people who are owning second or third homes. I mean, potentially one of the instruments of macroprudential policy would be loan-to-value ratios, but we're still at this point discussing a memorandum of understanding with the finance minister and the Treasury. But at the current state of the housing market, it's not something that, even if we had the ability to use that instrument at this point in time, it's not something that we would seek to be exercising at the current time.
The only thing I'd add to that is just to remind you that the macroprudential framework we're talking about, and we have mentioned 4 potential tools, one of them being LVR ratios. The objective of that policy is around systemic risk. So yes, we would have to consider, in order to use such a tool, that there was really a risk situation that was building in the banking system that needed countering through macroprudential policy that wasn't being handled sufficiently by the sort of microprudential tools that we use as a matter of course.
But it would give you some flexibility on the monetary policy side, given that that's how the Bank of Israel has used it. Shouldn't that be part of the conversation as well?
Well, it is part of the conversation. I'm just emphasising that it's the secondary part of the conversation. The primary one still has to be financial system risk. If you're using LVR ratios to moderate risk in the financial system, in all likelihood you would also be assisting monetary policy, but that wouldn't be the prime driver. That's all I'm saying.
Are you concerned then that too much hope or perhaps a misunderstanding about the role of macroprudential policy is emerging in terms of the debate about the dollar and the monetary policy framework?
I think that's right, because in a number of countries, and particularly if you look at the Asian countries, the term macroprudential policy really is being used as a monetary policy tool. Whereas if you go back to Basel and the true meaning of that policy, it is about macroprudential. It's about reducing risk in the financial system that arises from macro factors, from the business cycles and credit cycles.
There was a decision by the bank to expressly keep the macroprudential stuff sort of away from the monetary policy stuff. Can you elaborate on why that decision was taken? then?
Well, I mean, the bank has two objectives: price stability, and with monetary policy aimed at price stability, and we have financial stability with traditional prudential policy aimed at financial stability. Now, when the macro-prudential, our powers for macro-prudential are very much under the Part 5 of our Act, and that gives us the power to apply macro-prudential policy, but for the purpose of financial stability. Now, we're very much aware that it has the sort of second-round collateral effects, reinforcing effects for monetary policy, and we need to be aware of those, and the fact that we're doing both in the same institution, I think, assists in that regard. But all I'm saying is we need to keep in mind what the primary purpose is as we're using this.
You obviously decided, though, to keep it away from monetary policy. Did you look at the ability to use the macroprudential tools in the monetary policy sphere alongside the OCR?
Well, you have to ask the question, in what situation would you want to use a macroprudential tool to, with a price stability objective in mind, if it was not consistent with financial stability? That would give you a problem, because then you'd be using a tool that was set up for financial stability for another purpose, and we just don't think that's appropriate.
I mean, in many cases, macroprudential policy will be consistent and be supportive of monetary policy. But you can think of circumstances where that wouldn't be the case. For example, let's say we had a positive productivity shock in New Zealand. Then you might find it appropriate to ease monetary policy. But on the other hand, as a result of that productivity shock, you could also see credit starting to grow quite rapidly in the economy, and potentially asset bubbles tied in with that productivity shock emerge. So they won't always be supportive of one another. So the decoupling, I think, is quite appropriate, particularly given the financial stability objectives of the bank.
Mr. Wheeler, you mentioned the rising house prices in Auckland, up 10% in the last year. How overvalued do you think the New Zealand house market is, and what might spark a potential drop that could expose households, as you've indicated you're concerned about?
If you look at various indicators of house affordability, if you like, then New Zealand seems fairly high by international comparison. And we did have, during the period, I think it was 2001 to 2007, we did have the most rapid appreciation in house prices in the OECD area. If you look at house prices relative to household disposable income, then that ratio hit 5 times in 2007. The ratio now is about 4.5 times, but that's quite a bit higher than what it was in the 1990s when it was 3 times. 3 times household disposable income. Now, Grant's talked about the tightness in the supply side of the market. We've seen migration impacts in Auckland as well. What could bring it down? I think concerns that households have over high debt levels. The funding environment for the banks is still not where it was prior to the global financial crisis. I mean, accessibility has improved, but the funding costs are still not down to where they were. So that's an element which could constrain them. Or if New Zealand had a significant terms of trade shock that fed through the economy. Now that's likely to be driven by a slowdown in the global economy, and particularly around China and others. So there are the sorts of things that could build in lead to a correction in the housing market.
Do you think the housing affordability package the government released last week is going to be enough to relieve the supply side problems there, fast enough to avoid, another, or the risk of a bubble?
I'm not an expert on housing, but I think the measures, were certainly sensible. I mean, the Productivity Commission had a good look at housing affordability and particularly comparisons with Australia. And one of the issues around regulation and the use of freeing up of land, I think, was an important factor. How to build greater productivity into the housing construction industry is something also that seems to be important. So I think it's certainly an important step in the right direction. But did you have any?
Well, I'd just add that in our forecasts, we are expecting residential construction to increase substantially over the next couple of years. And we're already seeing signs of that in increasing consents, building consents. And so, most of that activity is Christchurch and related to the rebuild, but also it's picking up in Auckland. So, that supply response, and as well as to the sort of policy, regulatory type policies that in the supply side package, we're also seeing the basic response to the higher prices and the pressure in the Auckland market, the actual supply side and construction activity picking up, which is a positive thing in terms of rebalancing that market.
Could I just confirm, in terms of overvaluation, do you have any numbers on it? And as a follow-up question to your last comment, Grant, that supply coming on, do you expect the house prices to fall in any way or just level off?
We certainly expect the rate of increase to moderate, because in Auckland, house prices are getting up towards 10% increases. And, that's part of bringing that extra supply on stream. But once the supply comes on, we would expect the rates of increase in prices to level off for sure. We don't have a particular number of overvaluation. Unless Bernard, you have any observations on that, Bernard?
No, there's a wide variety of estimates out there, and it all depends on the particular metric we're looking at. But definitely, as Graham mentioned, on a historical comparison, we still look pretty overvalued.
In terms of... Okay.
Just in terms of that supply side response so far, the average value of a consent for a new house is something like $340,000. The average floor area is about 200 square metres. That suggests that the response is still very much skewed towards the top end of the market. Is that a concern to you?
I don't think we're close enough to the details to make observations on the composition of that supply response, but I would say it's really just getting going, and we'll see how that pans out over the next year.
In terms of global risks, you've mentioned the fiscal cliff in the United States in here, and I just wondered how big a risk is it that there isn't an agreement that avoids the full extent of the fiscal cliff, and how would that impact New Zealand? And are you at all concerned about the outcome of the election today in the US in terms of the fiscal cliff?
I think the outcome of the election will be interesting, particularly in respect of the makeup of the House of Representatives, the Senate, and the President. That's where the logjam occurs, and to see what configuration emerges, I think, is going to be extremely important. The fiscal cliff is of the order of 4.5% of GDP. That's the automatic spending cuts that are triggered and the tax increases. Now, depending on what happens to the composition of those different bodies of government, that will have a huge impact, I think, on what can be achieved. I don't think anyone would want to see a fiscal correction in the US of something like 4.5% of GDP for an economy that's essentially growing at around 2%. And if we get a configuration that's been similar to what's been the case in recent years, then what we'll probably find is very much an amendment or an adjustment that comes through around about the 31st of January or thereabouts, maybe a bit later, and it will be a log rolling sort of compromise that, who knows, maybe something of the order of 2% of GDP or something.
And is something in the order of 2% of GDP a big risk for New Zealand as well?
Well, I think, I think one of the key issues is you want to create a signal that the US is serious about fiscal consolidation in the medium term, given its debt ratios. But you don't want to create a significant drag on the economy in the short term. So we'll look at it very closely because the US is still 21% of world output, and what happens to its own rate of growth is still tremendously important for Europe and for ourselves.
You note the possibility of further strength in the New Zealand dollar. Is that stronger? Are you meaning stronger than your last forecasts there?
The exchange rate's an issue that we'll certainly talk about in the monetary policy statement in 4 weeks' time. We're just about to head into forecasting week in the bank, where we very intensively, the management and colleagues in the institution, sit down, and the exchange rate and particularly the savings, investment and balance that underpins it, given that in essence we rely on foreign savings to finance a lot of our consumption and investment. That's one area that we'll certainly be looking at.
And you note how foreigners are increasing their holdings of New Zealand dollars in their portfolios. What's your thinking on this, and is there anything the bank could do to mitigate this, do you think, or should be doing to mitigate this?
Well, in terms of the debt tenders, for example, run by the debt office, this is an economy with an open capital account. It doesn't wish to discriminate against flows of capital, and to the extent that foreign buyers participate actively in those tenders and help to reduce the borrowing costs for the government, then that's something I don't think one would want to intervene in that respect.
Are you saying that that would be one reason perhaps not to intervene in the New Zealand dollar, that it could have the effect of pushing up borrowing costs for the government?
Well, I think we'll come to the issues around the exchange rate in 4 weeks' time. Let's explore them in detail then.
Just on the dairying situation, the bank a couple of years ago went around the trading banks talking to them about their dairy loan books, so advising caution. Given that you're saying in this report that the equity positions of some of the most troubled farms are weaker now than they were then, are you contemplating going back and repeating that exercise?
Not at the minute, no. The situation you refer to is when the Basel II models were coming in, and we had concerns that the risk models that the banks were using did not adequately take account of all of the risk in the agricultural sector, particularly the dairy sector, and we sort of put a requirement, sort of like an overlay, on the risk weights or the models that underlay the risk weights for agriculture. So they've been in place, so those risk weights are now higher than they would have been prior to that intervention. but we're not reconsidering. We still think those are appropriate. All we're doing is saying is that the current situation, merits close attention by the banks in terms of how they manage the risk in that sector.
On open bank resolution, there were some more details came out last week, including your comment, Mr. Wheeler, about how this provided a better alternative for the government to bailing out a bank if it were to fall over, but only an alternative. Don't you think the open bank resolution process should be much more prescriptive about saying there would be no bailout? Otherwise, the moral hazard and the implicit government subsidy remains.
Do you want to take that?
Well, when you prepare for banking crises, there's only so much preparation you can do, because every crisis, when it does arrive, will be a little bit different from the last. So it's very difficult to say, here's one formula, this is how we're going to deal with the crisis, set up for it, and then that's exactly how you deal with it. So the key here is to give the government and ourselves options for how we deal with crises, banking crises, when and if they come along. And we think it's very important. The Minister and the government think it's important, and the international community and Basel Committee, etc., also think it's very important to have a tool like OBR in the toolbox as an option. But it doesn't mean to say that you'll necessarily be using that. But, the key is to have something there which means the government does not get tied into a corner, as, say, the Irish government did back in 2008, where they said there's no alternative but to bail these banks out. You have to have an alternative where you can keep the banking system going, keep the doors open, but also spread the losses across the shareholders and creditors of the bank.
So the implicit guarantee remains. Shouldn't then banks pay a fee for that implicit government guarantee, or why not just have a simple deposit insurance scheme where the costs are clear to everyone?
Well, the deposit insurance, is a separate issue, and the government. You can talk to the government about that. It's their call, but their assessment is that was not appropriate for the New Zealand situation. Of course, deposit insurance does not guarantee the non-failure or survival of a bank. The deposit guarantee is about making sure that individual depositors can walk away with a certain minimum amount. That doesn't save a bank, so that will not is not sufficient as a resolution or bailout policy. But I think the main concern is with deposit insurance is it actually, does create the sort of moral hazard issue that you're talking about, where if people say, right, we're guaranteed to get 100,000 back or whatever the threshold is, then it reduces the incentive to be very wary about the risks that are being taken. And I think that's the main concern the government had, is they want people to keep their eyes open and know what they're getting into. Because otherwise there's a risk that we repeat, some of the mistakes that were had with the finance companies.
Is there a risk that lenders have got overly conservative? You just noted in the report that SMEs and riskier ventures are struggling to get any kind of credit. Are there any risks to financial stability and that they go seeking that funding elsewhere to something that's not perhaps covered by your kind of prudential supervision? And do you have an expectation that lenders should perhaps be opening up their books to some of those SME markets?
Well, that's, you're right to some extent. I think generally we observe in the document that credit conditions have eased, so it's actually easier to get money now if you're a business. easier to get money from a bank on better terms. It was very tight just prior to after the crisis. But you're right in the sense that for the smaller businesses, it's still relatively more difficult. But, we don't make judgments about, what individuals should get a loan and what individuals should not. At the end of the day, the banks, the banking system, the borrowers and lenders have to cut that deal themselves. Have you got any? Yeah, go on, sorry.
I mean, it's been a feature. If you look at, say, the US economy and a number of the European economies, and also particularly the UK, as support from the government for the financial system has increased, governments had an expectation or certainly a hope that this would feed through into lending for small and medium-sized enterprises. And if you look across countries, it's been the one area where credit growth has been, or bank lending has been really quite moderate. And that's disappointing in many respects because a lot of the employment growth in an economy occurs in small and medium-sized enterprises.
You talk about increased foreign bond ownership. Are we seeing ownership from anywhere in particular coming through? Like nationality-wise?
I think it's quite diversified, actually. I think there's maybe more demand from Asia than there has been, which isn't that surprising, given what's happened in Asia. So less from the traditional markets and maybe more from the newer markets.
Yeah.
The report mentions that funding costs on wholesale borrowing offshore by the banks have dropped by about 50 basis points. That seems to have helped them boost their net interest margins and profits back to pre-crisis levels. Do you think the banks should pass some of that on to their customers in the form of lower mortgage rates and higher deposit rates, or are you okay with the banks pocketing that?
Well, if you look at the mortgage rates and particularly the competition around floating rate mortgages, in fact, some of these floating rate mortgages are, I think, down to around 5% now. So there is a lot of competition amongst financial intermediaries in the mortgage lending market. If you look at the returns on assets for the banks here, then they've recovered to where they were prior to the global financial crisis. But they're not high compared to most OECD economies. In fact, if anything, they're below many of the OECD economies. If you look at returns on equity, they haven't recovered to where they were prior to the global financial crisis, and part of that is because of the capital injections that are coming through in terms of Basel III and Tier 1 capital, etc. So what matters, I think, is that we have a healthy and efficient financial system which is competitive and is contestable, that there are not very large barriers to entry so that we can get the competitiveness and the efficiency. But in terms of profitability, as I say, ROA and ROE, we're not standouts by any means in respect of international comparisons.
Couldn't you argue that those OECD profit levels were too high pre-crisis and now anyway, given that they all got implicit government guarantees, including our banks?
You know, the ROEs for the risk-taking and the capital that's put in place, ROAs of around about 0.9 or 1% on assets. I don't think for the risks that banks take in intermediating savings and making investments and other portfolio decisions, I don't think that's an excessive return.
Just one final question from me on the payment and settlement systems review. Why have you chosen to do this review to toughen the rules? What's driving that?
Well, there's a lot happening in this industry, and there's a lot of innovation, and also that's happening domestically and internationally. And internationally, there are a lot of developments and new regulatory reforms that have come out of the crisis, which we are participating in to some extent. But in many respects, we're observing it as a small country looking internationally. But we feel that the existing powers we have are really quite weak. So relative to other regulators, so if you compare ourselves with APRA and RBA, we have quite very moderate powers in this sector. And we do have our what's called a designation framework, so that if a payment system or a settlement system wishes to have, it gets a bit technical, but if they wish to have the sort of Reserve Bank standard and be seen as accepted by the Reserve Bank, then they apply for designation. And we put them through the hoops and make them meet certain standards, and they say, right, you're designated. But that's a voluntary thing. So we have to consider whether, if it's a systemic payment system important for the New Zealand system, whether that should actually be something we can say, you have to be designated. The only actual powers we have at present in this sector are to seek information. So we really feel we need, in light of what's happening internationally and domestically, we need to review it and maybe beef up our powers in this sector. It doesn't mean to say we're going to go crazy, and I'm not sure you'll see, really a lot of change coming out of this, but we think it's an important thing to do.
Thanks very much indeed. Thank you. Thanks, Grant.
Thank you.
You did great.